Hey everyone, for the past 2 years, I've been investing $5 a day into two of the biggest powerhouse ETFs out there, VTI and SCHD. My goal was simple, build a rock-solid foundation for my financial future. But earlier this year, as the market bounced up and down, I had a thought. What if I could use that chaos to my advantage? What if I could turn volatility into income? Imagine if your Netflix, Spotify, and Friday Night Pizza were all paid for every month just from dividends. That idea led me to a new experiment. I started investing another $5 a day. This time split evenly between three high-yield monthly dividend ETFs, JEPQ, JEPI, and QYLD. These aren't just ordinary funds. They use sophisticated covered call strategies to generate consistent monthly income. And today, we're putting them head-to-head. I'll break down how much I've earned in dividends, explain how these ETFs actually work, and then we'll reveal the ultimate winner based on total return. Let's dive in. Before we jump into the numbers, let's quickly explain what a covered call is. It sounds complicated, but here's the simple version. Imagine these ETFs own a basket of stocks. They rent out those shares by selling the right for someone else to buy them at a certain price. In return, they get paid a premium, and that premium becomes our monthly dividend. Now, here's the cool part. When the market is volatile, those premiums get bigger, which means higher payouts for us. But there is a trade-off. By selling that option, they're capping their growth. If the stock price soars, they miss out on those bigger gains. So when we analyze these ETFs, we're not just chasing yield, we're looking at total return, which is income plus price growth. Let's break down each ETF and what I've learned so far, starting with JEPQ, which is the growth income hybrid. It tracks the NASDAQ 100, think Apple, Microsoft, with a flexible covered call strategy to capture growth and income. After investing $1.67 daily for 230 days, it means I put in $384.10, owning 7.5 shares at a $53.32 cost basis. My current market value is $419.35, and I've earned $12.32 in dividends. All have been reinvested, including $3.08 in August alone. Dividends started small, but have been growing as I've been adding shares, hitting a solid pace. JEPI is the stability champ. It targets a low volatility S&P 500 index, blending stable names like Procter & Gamble with tech giants like Microsoft. It's built for steady income. My $384.10 investment over 230 days got me 7.165 shares at a $56.20 cost basis. The current market value is $406.34, with $10.01 I've been paid so far in dividends, all of which have been reinvested, including $2.37 in August. JEPI's payouts are consistent but lower than the others. QYLD is the dividend king. It also tracks the NASDAQ 100 but sells at-the-money covered calls on the entire index monthly, maximizing income but capping growth. My $384.10 built me 23.9 shares at a $16.64 cost basis. The current market value of this investment is $405.14, with $13.73 paid to me in dividends, which have all been reinvested, peaking at $3.47 paid to me in July. QYLD is definitely the dividend leader, but does it win overall? Let's find out. So now we've seen each ETF on its own. Let's compare them side by side with dividends reinvested. Each fund got the same $384.10, and the ending values tell the story. JEPQ finishes at $419.35, JEPI at $406.34, and QYLD at $405.14. Because the dividends were reinvested, these totals already include both price appreciation and dividends. That means that what we're really looking at here is total return. JEPQ gained $35.25, which is about 9.2%. JEPI is up $22.24, or around 5.8%, and QYLD is ahead by $21.04, which is roughly 5.5%. If we were to rank purely on dividends, QYLD paid the most along the way at $13.73, with JEPQ at $12.32 and JEPI at $10.01. But again, those payouts are already baked into the total returns. Even though QYLD gave me the most income upfront, JEPQ ultimately delivered the best total return. That's because it balances income with growth, especially important in a rising market. JEPI stuck to its own playbook, delivering low volatility, dependable income, and ranks second in total performance, despite paying the least amount of dividends. So where does this experiment fit into my overall investing plan? VTI and SCHD are still my core. They're my long-term workhorses, slow and steady builders of wealth. But these high-yield ETFs, they're tools for a different job. If SCHD and VTI are like retirement savings accounts, JEPQ, JEPI, and QYLD are more like a monthly cash flow machine. Now, I'd love to hear from you. If you had a pick, which ETF would it be? JEPQ, JEPI, or QYLD? Drop your thoughts in the comments below. If you haven't already, consider subscribing to follow along with my $5 a day investing journey. I'm keeping this experiment going alongside with the other daily investments that I currently have running, and I'll keep sharing updates just like this as the story unfolds. Thank you so much for watching. If you're not sure what to watch next, check out another one of my videos right here. Take care, and I will see you next time.